What's up, investors? My name is Wes DeVore, and on this channel we talk about the long-term investing lifestyle, building surefire wealth over the course of 5 years or more, but really over the course of your entire lifetime. I have a great video coming for you guys where we talk about what the heck just happened to the markets yesterday at 2 p.m. The day started off red. Let's take a look at that. This is the past 5 days of the S&P 500. So the day started off red, and it looked like we were still in the correction or a correction from last week. But hello, the Fed sweeps in again with positive news to prop up the markets with the announcement that they're going to expand the function of their stimulus program of buying up corporate bond ETFs. So if you saw my last video, and if you didn't, you should definitely go check it out right now, because it's where I explain the Fed's current monetary policy and what has been the Fed's monetary policy since the Great Recession of 2008, what stimulated our economy since then, and they have the same monetary policy now, but now it's even more aggressive than it has been. And this is one of the major reasons that the stock market has had its massive recovery from the point of the market collapse and the height of the pandemic in March. So in mid-March, the Fed basically announced that they had a plan to inject way more money into the economy to support businesses and ease up credit by buying up corporate debt, including junk bonds, in the form of bond ETFs. They have a plan to buy $750 billion of corporate bond ETFs. They announced their plan to do so in mid-March. That stimulated the stock market. They actually started buying the bond ETFs, including junk bond ETFs, in mid-May. And then yesterday at 2 p.m., the Fed announced that they were not only going to be buying up corporate bond ETFs, but that they were expanding the function of their stimulus program to not only buy corporate bond exchange traded funds, but also that they are going to be buying individual bonds on the secondary market. So let's take a look at this CNBC article that came out yesterday, June 15th, 2020. The Fed says it is going to start buying individual corporate bonds. So if a company has fallen into a junk bond rating since March 22nd, the Fed will still purchase their bond as long as the company's bond rating was medium to investment grade before March 22nd, which is when the big collapse happened in the stock market. If you've fallen into a junk rating since then, the Fed is still going to be purchasing those bonds. What their plan is they are basically planning to still buy a wide index-like approach of bonds, but instead of buying bond ETFs, they'll be purchasing individual bonds on the secondary market. Now, they're basically going to be creating their own index basically portfolio of American companies' bonds. The decision to buy a broad portfolio of corporate bonds represents a shift. This is very important. A shift to a more active strategy for the secondary market corporate credit facility, rather than the passive approach originally envisioned. So let's take a look at the program that was established March 23rd, 2020 by the Fed to ease up the corporate credit standstill and support our markets during the height of the pandemic stock market crash. So on March 23rd, the Fed created this entity called the Secondary Market Corporate Credit Facility. And this program was basically given the ability to buy up $750 billion worth of corporate credit. And initially, this is very important. Initially, their plan was to only buy bond ETFs. So that's a passive approach to supporting the economy, because they're just buying a wide index of bonds, and then they're staying out of it. So there's no favoritism, which by law the Fed can't have any favoritism regarding corporations. But they have already started purchasing these bond ETFs. But yesterday, June 16th, 2020, they announced at 2 p.m., which is what happened to the stock market yesterday. It rallied up and ended up like 160 points higher, I think 167 points higher than previous close. They announced at 2 p.m. that the Fed's program, the Secondary Market Corporate Credit Facility, would be expanding the function of the program. So they would not only be buying bond ETFs, but they are going to be buying individual corporate bonds. So now they're holding bond ETFs on their balance sheet, and they're also going to be creating basically their own index, their own portfolio of bonds that they'll buy individually on the secondary market. So the CNBC article goes on to say that the intent of the individual debt purchases will be to create a corporate bond portfolio that is based on a broad, diversified market index of U.S. corporate bonds. They go on to say that this index is made up of all the bonds in the secondary market that have been issued by U.S. companies that satisfy the facility's minimum rating, maximum maturity, and other criteria. And basically, the bonds need to have been rated, this is medium to investment grade, by March 22nd. That means if they've fallen below this bond rating, and it became a junk bond, the Fed will still buy them as long as they were not a junk bond before March 22nd. But remember, they already started buying the junk bond in the ETF form before this. But now that they're buying individual companies, they will buy junk bonds only if they weren't junk bonds prior to March 22nd. So why is this so important? The Fed is basically showing investors that they're repositioning their strategy from taking a passive position by buying bond ETFs, index-based bonds, and now they've repositioned themselves to take an active strategy by expanding the function of this guy. No, not that guy. This guy, the secondary market corporate credit facility. And what does this mean for investors? Well, it means that, in my opinion, now this is just my opinion, but it means that we can be slightly more confident that the Fed is not going to let the economy completely tank. So basically, it means that we can be more confident that the Fed is taking a more active role in sustaining economic growth as opposed to their more passive role. What that could mean is that there's just less risk in the stock market right now that the Fed is taking a more active approach. Now that's basically my kind of speculation, but like as I described in my last video, this is a time of extremely loose monetary policy, and it's basically a paradigm shift, and Ray Dalio talks about this paradigm shift, and it's been happening since the Great Recession of 2008. So yesterday the stock market was having a pretty bad day. So this is basically the correction that happened starting last Wednesday, last week. This is when we got the news right here that the Fed was going to be purchasing individual corporate bonds. And the stock market rallied. So the Fed says that their indexing approach, meaning the bonds they plan to buy and put in their portfolio, will complement the facility's current purchase of exchange-traded funds. So what does that mean, it'll complement? I mean, it could mean two things. I don't really know what they mean by complement, but it could mean that they want to keep buying the same bonds that are held in the ETF portfolios that they started buying in March. And it could also mean that they want to fill in the gaps and buy individual bonds of companies that did not fall into the initial portfolios of the ETFs that they were buying. Only time will tell, but we can actually see what companies the Fed purchased through their initial ETF purchases, which is pretty insightful. And here is iShares iBoxx investment grade corporate bond ETF. This is the largest position they took with their initial ETF purchases. And we can actually look into that portfolio, which is here. So here is the iShares iBoxx investment grade corporate bond ETF. And we can actually peek into the portfolio and see what the holdings are. So here's the top issuers, here's the top 10, and it's very interesting. So let's go back to the top issuers. Bank of America, JP Morgan, we got Apple in there, Comcast, Wells Fargo, etc. So these are the companies that got the most support basically from the Fed's purchase of corporate bond ETFs back in March, and they just said yesterday at 2 p.m. that they plan to complement this. Now, this isn't all they bought. They bought multiple bond ETFs, and this was their largest position that they took. With a little more research, we could find out exactly. These are the major positions that they took with their first purchase of bond ETFs. They purchased these in May. So anyways, the moral of this story is that during this crisis, the Fed is trying to help out our economy, but who is benefiting? Only people who are really own financial assets are benefiting. So yeah, they did send out stimulus checks and there may be more coming, but if you really want to be on the right side of this, understanding the monetary policy is crucial, and becoming a long-term investor by beginning to accumulate financial assets to prepare yourself for the growth that we're going to be seeing in the coming years with all this stimulus. When things go back to slightly normal and we have all that extra money in the economy, and then all of these major companies have way more cash to work with to invest in new projects, the economy could see massive growth in the next few years. The best thing that we can possibly do is to educate ourselves about it and get on the right side of it, because the Fed is pumping out money, and if you want some, you have to own some financial assets, like stocks, to be on the receiving end of it if you want more than the $1,200 stimulus check from all the stimulus that's going out. So anyways, I hope you enjoyed this video, and I actually had a different video planned for the week, but because this was such huge news, I wanted to update everyone about it. So you definitely want to educate yourself about the current monetary policy that will affect our society and economy over the long term, so that you can get yourself in the best position to benefit from it. So anyways, please leave a comment below, and if you think I earned it, please hit that like button, subscribe button, the bell button, etc. It'll help my videos get picked up in the algorithm, and I would greatly appreciate it. So remember to always invest safe, make good decisions, and I'll see you all in the next video. Take care.